Hi traders, Gavin McMaster here from Options Trading IQ, and in this video we'll explore what high probability trading is, the strategies to use, the risks involved, and how you can start stacking the odds in your favor. Before we do that, just a reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So what is high probability trading? Well, it's all about taking trades that have a statistical edge, so typically aiming for a 70% to 90% probability of success. Instead of chasing large speculative payouts, these strategies focus on consistent, smaller profits by leveraging time decay, statistical probabilities, and favorable setups. Some of the key principles include selling time decay. So selling options to take advantage of time decay is an absolute cornerstone of high probability trading. So you're going to be looking at mostly option selling strategies. Another key principle is to manage probability. So you want to have trades that have a statistical edge. You want to use metrics like delta, implied volatility, and probability of profit, which we'll look at in a minute. The last point is accepting small wins. So it's very different to, say, swing trading, where you're aiming for large gains on a particular trade. You're willing to accept a few small losses in the hopes of getting a couple of big winners. Here, we're looking to accept lots of small wins and try to keep the big losses to a minimum. Some of the most popular high probability strategies include credit spreads. That's probably our number one. It's a really great strategy for beginner traders to get their feet wet. They've got defined risk. And as you can see here, this is sort of a typical setup. Let's say the stock's trading at about 55. We might sell a 45 to 40 put spread. We receive $100 in premium and we've got $400 at risk. So that's a pretty standard setup for a credit spread. We could also do the opposite on the upside if we wanted the bearish version, which would be a bear call spread. But again, the idea here with the trade is we're going to receive premium for placing the trade, and we've got a high probability of success, and we want to minimize the big losses. The next strategy is iron condors. And an iron condor is basically just a combination of the two credit spreads, a bull put spread and a bear call spread. So this is more of a neutral version. We're looking to do this on stocks that we think will stay flat. And similar to credit spreads, we want to be looking for stocks with a high IV rank. So we want to be trading these when volatility is elevated to give us a higher probability of profit and a higher chance of success. Naked puts are another great strategy. So this is our risk graph. In this example, we're selling a put option on a stock. Our strike price is 110. We receive $800 in premium for making that trade, but we've got the obligation to buy the stock at 110. So again, another popular strategy. It is a little bit more high risk and takes a little bit more capital because we've got effectively $11,000 at risk if we have to buy those 100 shares at $110. But we can generate a lot more premium than we can with a credit spread. And we definitely want to be doing this strategy on strong stocks, quality companies. If we do have to take assignment, we want to be able to hold that stock for a while, sell covered calls against it, and to turn it into something called a wheel trade. Alternatively, we could look to roll our position. I've got another video on that if you want to learn how to roll short puts to avoid assignment. But naked puts, one of the most popular strategies for high probability traders. The last strategy we'll look at is a short strangle. So similar to a condor, but we don't have the protection of the long strikes on our wings. So it's unlimited risk trade. So we do have to be aware of that. They can suffer big losses if the stock has a big move. So again, ideally, we want the stock to stay within a specific range, in this case, between 45 and 55. We're receiving $400 in premium for making this trade, but we do have unlimited risk on the upside and unlimited risk on the downside to the point of the stock going to zero. So probably not a strategy that you want to start out with as a beginner. You want to start out with your defined risk trades like a credit spread and a condor. But once you get a bit more familiar with the strategies and get a bit more experience, you can start looking at short strangles. So high probability trading depends on a couple of key metrics. So the first one is delta. You can use delta as a rough estimate of how likely an option is to expire in the money. So if we're looking at a 10 delta put option, it's got a roughly 10% chance that that option is going to expire in the money. Or if you think about it in another way, it's got a 90% chance that it's going to expire worthless. So again, that's a high probability trade. It's got a 90% chance of success. So typically you want to be looking at A 10 delta, 10 to 20 delta is still considered high probability. We don't want to go really any lower than 10 delta. If you go down to sort of a 5 delta, you're not getting a lot of premium and you're still taking on a lot of risk of a big move. It could impact your trade adversely for the amount of premium that you're getting. It's not really worth the risk. So around that sort of 10, 15 delta is sort of a good spot to be for your high probability trades. Probability of profit is another important metric. So again, we want to be looking at 80% plus probability of profit for most of our trades. Some other metrics that you might want to look at include implied volatility rank and implied volatility percentile, and this can help you identify when option premiums are elevated, which can enhance your chances of successful trades. High probability trading offers a number of benefits. So firstly, it has good income potential, so you can focus on trades with a high chance of success and generate consistent income. Secondly, they leverage time decay, where we're taking advantage of the natural erosion of those option premiums and getting that to work in our favor, and taking advantage of the volatility risk premium that sort of states that option prices are generally overestimating the impact of volatility and therefore overpriced in the long run. And some of them are defined risk. As we looked at credit spreads and condors, that can be a benefit that we can trade these high probability strategies, but we know that we're not going to blow up our accounts because we've got defined risk. So particularly if you're a beginner, you want to stick to those credit spreads and condors. So obviously high probability trading has a lot of benefits, but what are some of the risks? One of the major risks is the asymmetric risk to reward profile. For instance, a credit spread might offer a $100 premium, but expose you to $400 in risk. So a single loss can potentially wipe out gains from multiple trades if the trade isn't managed carefully. So again, when we're doing these high probability trades, we don't want to just put them on and forget about them. We want to manage them. We want to adjust them. We want to hedge them. And we want to have diversification and offsetting trades as well. So there is a little bit more to it than just entering the trades. I always say entering the trade is the easy part. It's what comes next that's hard. So you want to learn about trade management as well. And we've got some other videos on that if you want to check those out. Another big risk is sudden volatility spikes. Generally, the strategies that we're looking at for high probability trading, and certainly the four that we've looked at today, negative Vega trades. So that just means they're going to benefit after you place the trade, they're going to benefit from volatility dropping or staying stable. So if we place these trades and then there's a big volatility spike after we've placed the trades, that can adversely affect these positions. Events like earnings announcement or geopolitical shocks can cause large unexpected moves, and that can lead to significant losses. To succeed, you must remain disciplined and have robust risk management in place. So a couple of tips for you. Number one is prioritize risk management. So define the maximum loss on each trade and try and stick to it. You can use price alerts, proper position sizing, and adjustment rules. Things like that will help you with your risk management. You want to choose favorable metrics. So you want to look at trades with a high probability of profit, an acceptable delta, and you want to be looking at trades with a high IV rank. You want to stay disciplined and avoid emotional decisions. You don't want to chase losses or overtrade. You're going to want to monitor and adjust your trade. So regularly check your positions, adjust them if necessary. With things like naked puts, it's very easy to roll those before they go in the money. Again, got a video on that if you want to check that out. You want to diversify and spread your exposure across a few different strategies, timeframes, and also different assets to reduce risk and improve your consistency. So you don't want to be trading just tech stocks or just blue chip stocks, or just stocks that have a high implied volatility percentage, not necessarily a high IV rank, but very volatile stocks. Think about sort of recent IPOs and things like that. You don't want to be concentrating on those particular sectors. You want to try and diversify, have some defensive names, have some tech names, and have different underlyings from different industries and different asset classes. High probability trading is a powerful approach for generating consistent income, but it requires discipline, risk management, and a clear understanding of probabilities. By combining the right metrics and risk management, you can stack the odds in your favor and build a sustainable trading framework. That's what it's all about. Make sure you check out all the resources in the description below. Reach out anytime with questions. Thanks for watching and have a great day.